Hello, dear eTorians, followers and copiers. This is PC here from GlobalAlphaS. It's the 1st September today, so I thought it's a good time to summarize the month of August for our global leaders portfolio and give you a little bit of a grip on what drove the portfolio itself and the markets too. I will do it in 3 quick steps. First, I will present you the general performance of the portfolio. Then I will move on to how the markets in general performed and what were the major drivers for the month of August. And I will finish up with concentrating on the details of the global leaders portfolio, what drove it, or which were the biggest movers, drivers, and at the end I will just give you my view on what I think is going to be the biggest stories for the markets into the year end, and how my positioning is going to be for 2021 and 2022. So let's just start quickly. I will present you my screen. Just a sec. Okay, I hope you see it now. So let's kick it off. Our portfolio added up 2% in August, which is a very good performance. I think we have another month in a row where we are either flat or up. The 6th month in a row, pretty much. March we were up 8 basis. May we were down 20 basis. So these returns are pretty much flattish. The other 4 months out of the last 6 months, we were up constantly. So this fulfills our target of bringing stable positive returns and minimizing drawdowns for our investors. Obviously, going forward, we will have up and down months, but my personal absolute target is to be maximizing the number of months being up, and first thing, bringing long-term yearly positive returns on a very, very regular basis with constrained drawdowns and very high risk control. The start of 2 months here, we were refurbishing the portfolio, increasing the equity portfolio, the equity share in the portfolio, and we had a little bit of a vulnerability here because of the sudden rise in the yields, obviously, when the growth stocks kind of underperformed. But since then, we have done a great job of stabilizing the returns, as the portfolio was already prepared for the economic cycle phase, which is expansion. And we're doing just fine right now. Year to date, we're up 6% so far. So with the risk control, I think it's a good performance, and hopefully we are going to get more alpha as well into the end of 2021. Just quickly, 6 months average holding time, as you see here, will only get longer, most possibly. Slightly less than 60% profitable weeks right now. So let's move on onto what was happening in August. Here you can see a pretty interesting article from CNBC. Just to summarize it quickly, year to date, S&P is up 21%. There's been no 5% correction so far. We've had 7 straight monthly gains for the S&P 500, and August was the 3rd straight month in which the S&P has risen more than 2%. Namely, it was 3% in August. Remember that S&P 500 is by no means our benchmark, right? We're allocation swinging fund, so this is not our target at all to be benchmarking against any kind of equity index. We have totally different targets in our global leaders portfolio. First thing, it's maintaining long-term yearly positive returns and minimizing drawdowns, right? So our major target is basically to maximize the risk reward ratio for the portfolio, keep very tight risk control, and concentrate on providing positive returns with minimal drawdowns. Now, I want to show you very quickly two interesting graphs from this article here. These are the drawdowns for the S&P 500. As you see here, we were down 35% in 2020 during the pandemic. But since then, the drawdowns have only been falling, right? So as you see here, this is what worries people waiting for the correction to come just around the corner, which is not coming, right? Ever lower drawdowns. And this is a problem because most of the participants of the market that are not in equities, they are kind of, the longer this lasts, they are kind of made to participate in the rally. So this is basically not a sign of an immediate correction, but rather it's a sign of a strong bull market building up going forward. 10-year annual roaring returns. On that basis, bear markets usually come when the 10-year rolling returns are at around low 10s, as here and here, for instance. But right now we're in the high 15s, 20s currently, which, for instance, here were usually the moments of great returns and the strong markets, right? So let's just move on to earnings right now. This is a screen from Bloomberg showing you the sales and earnings surprises of the S&P 500 constituents for the second quarter of 2021. Average sales surprise almost 5%. An average earnings surprise of over 16%. That's a great job done by the corporations this quarter. Expectations were very high this quarter. They have been rising since ever the third quarter of 2020, but still the corporations made it with a very nice beat on the earnings basis. So this has not only supported the equity markets in the shortest term, but this has already kind of corrected the market valuations on a relative basis by itself, because obviously once the earnings surprises are positive, the market consensus of forward earnings rises, bringing the forward PEs down, right? So without a correction, the market kind of got cheaper by itself. Biggest surprises have come from cyclical sectors, which were financials, 30% positive surprise, communications, 21% positive surprise, consumer discretionary, almost 24 positive surprise. So this is pretty typical for the expansion phase, right? For the early expansion phase, where the cyclicals are the ones that kind of gain the most of the economic environment, right? So great numbers, and this is definitely a very big thing. The other big thing for August was obviously the Fed. I think FOMC and Mr. Powell have done a great job driving the market expectations and giving the market really what they wanted, and not more and not less than that. The expectations for an announcement of taper were big, and eventually, in a very dovish way, Mr. Powell did that in his last speech, but he did it in such a way that did not spook investors and caused no tantrum reaction as we had in 2013. We will get more details definitely during the September FOMC meeting, which is, I think, at around the 20th of September. So I will be watching that closely, because we will definitely need to prepare for the tapering, whether it comes without a tantrum or with it, as for instance in 2013. You still need to prepare for tapering. The liquidity will be smaller, the market will be more vulnerable, and I think the volatility will eventually spike a little bit. So you need to be prepared, which we will definitely do. As you know, I always listen to the Fed, and I think this is what all investors should do, and definitely not play against the monetary policy authority. Now let's move on to China. As you know, there's been a massive Chinese regulatory crackdown on the biggest Chinese tech names, right? I won't go into details of that right now, as most of you possibly know what is all about. I just wanted to give you a little bit of a grip on how the Chinese names performed in August and what was the impact of them on our portfolio. Alibaba was down almost over 20% at the lows for the month. Baidu, that's the green line here, was down as low as 16%, and CQQQ, so the Chinese tech companies at the ETF, was down more than 10%. But into the month, and as the situation stabilized and we got some of the laws planned already having been voted and introduced, we saw a situation calming down, and many of the Chinese names have come down substantially. Eventually, Alibaba ended down like 14%. This graph here does not take into account yesterday's good day. So I think at the end of the month, Alibaba is down like 13%, and Baidu is down like 5%. CQQQ is down roughly 2-3%. We have bought into the Chinese market mostly in the second half of July. You might say it was maybe a tiny little bit too early, but I think in general, from a longer perspective, it makes not much of a difference. I think all of those names are extremely oversold, both fundamentally and technically. I will show you why I think so in just a little second. But as you see right now, in CQQQ, we're pretty much flat already because the market has opened. In Baidu, we're up 3%, and for Alibaba, we're down now 7%. At the end of August, we were down roughly 10%. So we're having approximately 15% of the portfolio in Chinese equities right now, and I plan to be keeping this exposure to diversify both geographically and play the tactical trade for a big rebound in Chinese tech companies while the regulatory and political situation calms down. The fundamentals: Alibaba trades right now at a forward PE of 2.2 and a PEG ratio of 1.2. These are extremely low valuations, not ever imaginable for names like Amazon or Google. If you would compare Alibaba and Baidu to its US peers right now. Price to book for Alibaba, spot 45, extremely cheap. In case of Baidu, you get a forward PE of 2.2 and a PEG ratio of 1.7, plus the price to book ratio of spot 23, not imaginable in US. And I think with all the political risks around Chinese tech companies, this opportunity should not be missed, and that's what we did in July. We increased exposure to China, and we plan to stay exposed to those great value names. From the technical perspective, as you see here, this is Fibonacci. Alibaba has given out 62% of all its gains from 2015 to the end of 2020 in just a couple of months, really. So also extremely sold off on an MACD oscillator basis. It's also sold off like pretty much never in history since ever the stock was traded on the New York on the Nasdaq, right? So yeah, oversold, great fundamental and technical opportunities in China. We took advantage of them, and we plan to provide good additional alpha to the portfolio into the year end from the Chinese exposure. Moving on, gold, moving on to other classes, right? Gold started out at 170. Not gold itself, right? Not the spot bullion, but the GLD, the spot gold ETF started out at 170. We had a dip, we were down to 162-ish throughout August, but we're pretty now flat on month right now at the end of the month. So into the year end, I expect in gold to be trading higher, as it's a pretty typical inflation hedge. So given the recent volatility, which is now mostly played out, I think eventually gold should be higher as well. Tilt as a proxy for our treasury holdings. performed with no much fireworks in August. There has not been much swings in the US yields throughout August as we had in the months before. So pretty quiet here, and I think the exposure here will stay as it is in the upcoming months. Now I wanted to show you guys a couple of very interesting graphs to finish my presentation today. First thing, the earnings per share for the S&P 500 as of now. We have a consensus earnings per share for the S&P 500 between 2010 to 2030. Let's take an average of $220. Sorry. And an average PE for the S&P 500 of 21 right now. We're getting an end of year target of 4,620, which is still a 2-3% upside from here. And if you look at it from a bit longer perspective, way into the 2020, should you assume the EPS growth of like 7%, which I don't think is that much unachievable given the performance of the corporations in the recent quarters, we would get $260 earnings per share for the end of 2020 roughly, and with a PE of 21, this gives you an S&P end of year 2022 target of 5,460, which is roughly a 20% upside from here, right? So should the economic conditions not change, and should we not get any more new issues that we don't know of right now, we can still expect the equities to perform quite nicely in 2020. Guys, this is it for today. We're doing okay. We're doing good in the portfolio. I invite you to follow me for regular updates. I would also be honored if any of you would start copying me. The portfolio is doing as expected, and we're adding more profits with a very stable kind of characteristic of the fund and constrained drawdowns, which is by far our major target, right? So this is it for today. Thank you very much. This was PC from Global Alpha Search. Please ping me a message if you would like to talk or get any further details on the portfolio, or should you have any other questions, I'm also available on my feed, on my social media, or just directly as you wish. So this is it for today, guys. Thank you very much, and I see you soon in my further materials. Thank you.